Oh, forgive me. I'm sorry. Jonathan Gerber here with RVW Wealth, and wanted to give you some perspective on what's going on in the world. Like we've seen over the last 24 months with the pandemic, anyone who tries to predict market movements relative to world events will find themselves licking their wounds. Today, a day when we've got only terrible news coming out of the Ukraine and the war, we see strong market performance. And what we want to do with this hour we have together is to help each of our investors and our clients understand how equity markets perform over time and how the portfolios we've designed are performing and what we actually own in our portfolios. First of all, we see ourselves as business buyers, not frenetic traders of stocks. And that gives us the benefit of looking at the values defined by the underlying profits of the businesses rather than market sentiment. And the other important thing to understand when becoming an equity investor is that equity investing only works over time, not all the time. And as equity investors, you must be willing to embrace volatility, recognizing that it is the price we pay for the profits and the growth which we expect. And finally, before I turn it over to my father and then ultimately to Stefan, we've always advocated equities as being appropriate for investors who have the ability to tolerate volatility and have the investment horizon to endure what we expect all the time is short-term market volatility. And with that, I'm going to turn it over to my father, who will go through some of the more specifics that support the theses that I've just laid out.
Thank you, John, and good morning, good afternoon, good evening to all of you. We're delighted to have people logged in, watching from literally around the world. And as we always say, there are two kinds of people. There are people who are clients of RVW and those who aren't clients yet. For those of you who aren't clients yet, we hope particularly you will find it interesting to see how a data-driven approach where we suppress feelings, instincts, forecasts, and memory and work on current data to derive at portfolios that demonstrate resilience and reflect the value that Jonathan referred to, which is buying great businesses. And how do we do that in a systematic, reproducible, tax-efficient, low-cost manner? And in particular, what we want to look at is how equity markets are behaving now and how they might behave in the unfolding future, given the financial strength and current situation that they find themselves in. Let's take a look at the data. Okay. First of all, we are currently in a very strong position. The data will show you that corporate balance sheets are very strong. Earnings of corporations are growing and expected to grow, even, by the way, in the eyes of the people who really know, which is corporate America, even with the current situation insofar as they're able to tell. But assuming that growth of earnings isn't quite at the rate that was expected before Ukraine, you'll see that there's plenty of room to come down and still show a very solid growth track. The second important thing to remember is that American consumers have rebuilt their balance sheet since 2008, and you will see how the net worth and the cost of debt servicing are at unprecedented heights and lows, respectively. The American consumer have rebuilt their balance sheets. They have massive net worth. Their homes have gone up in value. Their 401ks have gone up in value. And those that didn't work have built up cash reserves because they didn't pay rent and they got checks in the mail. And they have a very low debt service to income level, largely because interest rates, even with the current upticks, are at very low levels. It's also very important to remember, and this is a critical piece of the puzzle, the US economy is 70% consumer driven, which is why the health of American consumers is so critical. And we are 90% domestic. So what happens outside the world only impacts about 10% of our economy. Further kind of tailwinds for the portfolio, as you will see, are that stock buybacks are continuing at unprecedented rates. Those stock buybacks are indicative of several things. First of all, corporations have excess cash that they're able to use for this purpose, and that's always healthy. But more importantly, our view of stock buybacks is a statement by the people who know the most about the company. In other words, managers, owners, operators. the board of directors, believe that the best thing they can do with excess funds, as opposed to all the other options that they have available, is to buy back their own stock, which is an indication that in the eyes of the people who know, stock is undervalued. It also acts as a braking system so that when stocks are going down, these buyback programs are typically and usually activated. And so there's a kind of a braking system on collapse of equities. And finally, in this section, I want to make the point, and you will see it, that in relation to earnings within the interest rate levels that we're currently at, equities are not overvalued. These are job openings, and there is a huge amount of unfilled labor need. I'm sure you know that from the newspaper. But what this means to us is that we're unlikely to find unemployment. Given the huge number of job openings, recessions are usually accompanied by, caused by, and then further exacerbated by unemployment. Given the huge number of job openings, that is not likely to eventuate. And this is an important slide because it shows you the components of the gross domestic product. As I said before, the big blue chunk in the middle there is consumption. That's American consumers. That's the 70% that I referred to earlier. We only have about 4% of our portfolio in exports, so we're not dealing with anything there that makes a big difference. Imports are not much larger than that. We're basically more or less a largely self-sufficient economy, so that as bad as things may be in Europe, and they have a very different story for reasons that I will get to, it's unlikely to have a very significant impact here because of our kind of sealed in, almost or certainly largely self-contained economy. I want to look at the consumer balance sheet with you and their debt service ratio to support the points I made earlier. Take a look at the balance sheet on the left. The stack of assets on the left reflects the assets. The small little pile on the right of that slide are the liabilities, and the difference is net worth. If you look at the bottom right, you see a very strong growth in net worth and a full recovery from the dip after 2008. Top right, you see the debt service ratio at all-time lows. So corporate America is healthy, and consumer America, the average American, financially healthy also. Looking at corporate America to see the health, profit margins are very high, largely, by the way, due to the efficiencies of the digital revolution. The digital revolution is entering and has entered every aspect of our economy and of our lives, resulting in more profits, more efficiency, and therefore, from our standpoint as business owners, making equities even more attractive. You can see the projected earnings per share, and you don't need to look at the numbers in great detail to see there's a very big anticipated earnings growth over the next 3 years. And even if that weren't quite as strong, impressive as these projections look, because they certainly didn't take into account the Ukraine situation, even if they were not quite that strong, we still can expect strong growth in earnings because of the reasons I've said and others. And let's talk about the tailwinds that will continue to drive the economy are already in place. The first one is that the pandemic looks like it's finally ending. And that will definitely unleash huge pent-up demand in areas that were most badly affected by the pandemic. Travel, entertainment, leisure services, and greater spending in areas related to those, so that this should, certainly be a countervailing force to the cutbacks that may be caused by the higher gas prices. And as I pointed to earlier, record excess demand for labor. And there's a ton of data here, which I won't bother you with, but you can see that we're unlikely to have unemployment at the current. And the next is policy, which is always critical. One of the big pieces is policy. And the government and the states are likely to create some incentives to ease the pain. They typically have done that, and we expect that to happen. The digital revolution of digitization, robotics, and so on, as I've said, affect everything. And the final big point is the onshoring post-pandemic. It was clear at the time how horrifically dependent we were on outside countries for some essential elements of what we needed in this country, and especially China, I think will look to see significant cutbacks in manufacturing by them and exports to us. That's already happened, and it's a trend that should certainly continue. Looking at history, it would be useful just to see previous responses to geopolitical events. And if you take a look down at the left, you see those blue lines, those horizontal lines going leftwards, and that gives you the magnitude of the decline in the S&P 500. On the right, you see the number of days to recover. Those early days of the Pearl Harbor and Kuwait and so on were very different in the sense of the Fed not being in as much possession of data and not being as proactive as they have subsequently become. But if you look down, it looks like, certainly even from a cursory, that the dips are more shallow and the recoveries are shorter. The blue lines tend to get shorter over time, and so do the yellow lines. So the dips have tended to be less significant over time, and the recovery periods have also been shorter. So, and that we saw that most manifest in 2020, when we had the shortest bear market in history. And that it was largely caused by Fed intervention, which they're committed to do. They've told us that they will do, and they've done it when needed. We see others over here. We see that the average total return 6 months after an event is 5%. The average total return 1 year after one of these geopolitical sell-offs is 9%. And we see it over here as well. There's not a single period over here where after 5 years, a portfolio designed in this way, which is a balanced equity bond portfolio, not a single 5-year period where there wasn't a full recovery, not one. And over here, it's always useful to step back and see what happens to equities over long periods of time. This is a very long period, 26 to 2020. But you see the dramatic growth of small cap in particular and large cap compared with bonds and compared with treasuries and inflation. Look at inflation at the bottom there at about 15 or so percent. $15, sorry, from one. And you see that very small impact on the small cap and large cap growth. In other words, equities are a way to combat inflation. I will come back to that, but you see it over here over long periods of time. Equities are one of the most attractive ways to combat inflation, and you will see the growth of dividends and corporate profits to reflect that. People tend to panic. Most people do. That's why most people think the stock market is risky. And of course, we know the difference between risk and volatility, and I will come back to that. But take a look at if you miss the best 1, 5, 10, 20 days out of a long period of time, 1990 to 2020, that's 30 years. And you see what happens, the difference between what a dollar amounts to, well, in this case, $1,000 amounts to, over a short period of withdrawal, and then the more days, and you're talking just a few days of strong returns, dramatically impact performance, because the market does not go up in a smooth, rateable way. It goes up in spurts. And if you miss out on 10 or 15 or 20 of those spurts, you can almost never make it up. And you can see it by the end over there, you're basically marginally better than a treasury bill. This is an interesting chart. I'm not sure how well you can see it on your screen. I can see it pretty well on mine, and I'll read it to you. This is what I would call Mr. and Mrs. Misfortune. They decide to get into the market in 2008 at the very height, just before the global collapse of 2008, 2009. And you see in very short order, their $10,000 drops to 5. I'm not sure if you can see that clearly, but there's that very big dip on the left. But fortunately, they had been marinated in the RVW source. So they did nothing. They sat, believed the theory, believed in the power of markets to grow over time, and they watched their portfolio grow from $10,000 to over $40,000 in 2021. All they needed to do, by the way, was to look at all those screaming headlines and all those pundits who were pointing out how the market was going to collapse. We call them the doom and gloomers. All they needed to do was ignore them, and they were amply rewarded for that ability to remain calm and collected, or as we call it, calm and collecting, growing dividends and growing value. So that is the big challenge, to ignore the news, ignore the headlines, and stick to the basics. We use a different metaphor for this, which I hope you'll find meaningful. We say we watch the playing field and not the scoreboard when we're at a sports game. Most people don't understand that the scoreboard is a result of what happens on the playing field, and that's where the action takes place, and that's where one should focus on how do you own fractional interests in successful businesses. That's the goal. Now, this is a very important analysis. It shows for each of the years from 1980 until the current year, the growth over the year or for the year, in other words, the appreciation in the market using the S&P as the index for that, from January 1st to December 31st. So if you look at the blue lines, you see that they're overwhelmingly positive, although there are some negative years. But more importantly, you'll see that almost every year, in fact, every year that I see here, has an orange line. The orange line is the low point during the year. That's what's called the intra-year decline, the low point during the year. If we look at the left chart, you will see that for the year of 1980, the market grew by 26%. So if we were at a Christmas or Hanukkah party with friends, with clients of ours, they'd be thrilled that they had a really spectacular year. But right next door lives nervous Nelly, who says, wow, you know, I saw my portfolio go down by 17%, and I couldn't stand the pain, so I sold out. So you have two people living next to each other, one of whom had a 26% year, and the other one had a minus 17% year, a 43% difference in their experience. Most people fall prey to that idea of bailing out when the markets are down, and they can't figure out why Warren Buffett is rich and they're poor. So this is a very important slide. But what's very relevant about that today is that the average intra-year decline, and this is absolutely critical to right now where we are, the average intra-year decline is 14%. That means on average, the market goes down by 14% at some point during the year. Let me assure you, depending on how your portfolio is constructed, you should not be at or very close to 14% yet. You should not be there yet. And we've suffered a pretty brutal year with a potentially flattening of a country. So just thought that would be a very interesting slide in terms of perspective. In terms of bull and bear markets, because a lot of what we do is build resilience into our portfolios and also into our clients. Take a look at the history of bull and bear markets. The blue is the bull and the orange is the bear. By the way, just so you know how the names came about, the bull kills its prey and attacks its prey by going from the bottom and casting it up into the air. So it has an upward movement. That's why that upward movement is used to describe an optimistic or upward trending stock market. We use the image of the bull, and the bear kills its prey by stomping on it, which is why we call that a bear market. In our more cynical and skeptical moments, we say you probably have your stockbroker giving you so much bull that you can't bear it anymore, but that's not for now. So here's a way to look at things as we proceed through the data. Every market downturn looks like a buying opportunity in retrospect. And they all look like unfolding catastrophes when you're in the middle of them. And we're in the middle of one right now, potentially. And it will look, in retrospect, in time to come, like a buying opportunity. But you saw from the previous chart that bull markets are way stronger in terms of, let's just take a look at that because I think we need to give it a little more time. You look at that and you see the bull, the blue, is far wider, which means time duration, than the bear, which is orange. It's also more intense. If you look at the ups of the blue compared with the downs of the orange, you will see that the bull markets are not only longer in duration, but more intense in magnitude than the bear markets. And in fact, looking back all the way to 1942, you might say that the entire story of equity markets from 1942 is one long bull market interrupted by occasional downdrafts called bears. But it's basically one long bull market with occasional downdrafts. It's not an up and down market. People think the market goes up and down. That is not true. Hopefully, airplanes go up and down. Elevators go up and down. As you can see from this, historically, the market has not gone up and down. It's gone up, 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 and an occasional step back, either a small one or a large one, and then proceeded with its relentless move upward over time. I'd mentioned that the buybacks were a tailwind for the stock market and acted as somewhat of a brake. Take a look at the magnitude of stock buybacks, and this has accelerated already into 2022. One of the ways that one can value stocks, because I mentioned earlier that we do not believe stocks are overvalued at the current time, fundamentally overvalued. We do not believe that, and this is one of the sources of that conclusion. If you take a look at the comparison between the red, which is the forward earnings expectation on the S&P 500, and the blue representing the 10-year Treasury, you see that for long periods of time, they were absolutely on top of each other, almost like two snakes on top of each other on the left. And suddenly they diverged. And that divergence is atypical. And if that were to narrow, equities could be moving up significantly. By this valuation, equities are significantly undervalued, because unless you're expecting a very significant increase in interest rates, which would cause that blue line to move up towards the red line and begin the process of what economists call equilibration, reverting to long-term trends, unless you believe interest rates are going up very significantly, or you believe that corporate earnings are going down very significantly, which would cause the red line to move down. And we don't believe either of those, but unless you believe those, you're left with no option but to say that the only way this thing can equilibrate over time, not currently, not next week, next month, or next year, but over time, the only way this thing can equilibrate is if equity values go up so that the yield goes down, the earnings yield goes down mathematically, which brings the red line closer to the blue line. If you didn't understand that, forgive me. It is somewhat technical, but I just want to make an offer to anybody watching this. Send an email to any of the members of our team. We'd be happy to respond by email or by phone. Our emails are all very easy. Mine is sg at, Jonathan is jg at, Stefan So is ss at, and Jesse is at jp at. Whoever you've dealt with, whoever you feel comfortable, and the rest of that email address is always at rvwwealth.com. So just again, sg at is me, Jonathan is jg at, Stefan So is ss at, and Jesse is at jp at. And we would welcome your questions, comments, or a further explanation of anything that is covered here or anywhere else. We've covered this previously. Well, I'd mentioned to you previously, and John said this, that we distinguish risk from volatility. We regard risk as the possibility of permanent loss of capital. We regard volatility as the market's manic depressive bipolar appraisal mechanism, which periodically overvalues and undervalues equities in the short run. Warren Buffett has an absolutely amazing story, which when I first heard it about 3 decades ago, literally changed my view of equities. Here's what he said. He said, when you're in a diverse group of quality equities, it's as if you're in partnership with a mythical fellow called Mr. Market. And this Mr. Market knocks on your door every day to make you an offer to buy out your share of the business that you own in partnership with him. And he says, the problem with this fellow is he's prone to severe mood swings. He goes through periods where he's up, optimistic, and effusive. We call that a bull market. And in those times, he's proud and happy to offer you a very high price for your share of that business. But then he goes through periods of being down, forlorn, and depressed. We call that a bear market. In those times, he's only offering you a pittance of the true value. And here comes the mind-changing, insightful insight of Buffett. He says, in the short run, the price of what you own is determined by the mood swings of your partner. But in the long run, the value of what you own is determined by the profits earned in the businesses you own. Now, how do we separate risk from volatility? We regard risk as manifest in one of 2 ways. If you look at any individual stock, it represents really 2 ways that you can experience risk. One is you could be a victim of company-specific risk. So if you think of Boeing, nobody expected the 737 disaster or the other disasters that befell Boeing successively after that. So that's called company-specific risk. Unknown, unknowable, but it exists in every company. Volkswagen has it with Dieselgate and so on. Teva in Israel had it. Company-specific risk. Everything looks amazing for the company until suddenly it doesn't. How do we deal with that? We diversify. Portfolios that are RVW designed own fractional interests in over 5,000 companies. Diversification is known as the only free lunch in the market, and we indulge in that in great deal. So over 5,000 companies, no individual company can impact us. We're looking at a group of companies. And the second risk that can manifest is sector-specific risk. If the sector you're in goes out of favor for some fundamental reason, you will be impacted by that very severely. But we remove that also by diversification into multiple sectors. When I say remove, one cannot entirely remove, but you minimize significantly the impact of any sector going south by diversifying into all sectors. And when we've managed risk in that way, we're left with something entirely different called volatility. And I've just referred to that, and John did as well. So this is the key. This is the key. And there are people in the world who understand it very well, and they do well generally if they've got a well-selected portfolio, and they come a cropper, as we say. They hit the skids if they're expecting the market to go up all the time. We often look at it this way as a man walking up the stairs with a yo-yo in his hand, or a woman with her hand, and the key is to watch the feet and not the yo-yo. And so that is where we go. Now, looking at the real threat we're facing, which is inflation, and that's very likely to transform from what looked like what we called a situational inflation to a fundamental inflation brought about by current geopolitical events. I want to show you how equities have done both total return and then net of inflation, and you'll see that over time, gold and bonds and cash have all done significantly worse than equities, which have held their superior performance even in times of great inflation. Here's the price of the Big Mac, and we use the Big Mac, we watch it quite carefully because the Big Mac is unique in many ways. It's very difficult to compare prices of many products. For example, you cannot compare the price of television screens, because a television today is an entirely different item from what it was 5 or 10 years ago. You cannot compare an automobile price to what it was 5 or 10 years ago, because it's an entirely different item. In fact, if you own a Tesla, you don't even own an automobile, you basically own a large computer on wheels. So the thing about a Big Mac that's interesting is it's unchanged and contains a good ingredient composure of raw materials, labor, and overhead. And take a look at how Big Macs have been able to push their prices through to highest selling prices, increasing their profit, increasing their stock value over time, because they were able to do that. And by the way, for those of you feeling bad about spending more money at the stores when you go shopping, just remember, we own the businesses that are selling those products to you and making the increased profits. So we're not only paying the price at the stores as we consume at higher prices, we also own the businesses that are benefiting by being able to flow them. There's an old Big Mac menu from the McDonald's menu from the 70s. I'm sure many of you reminisce about how prices used to be, if you're familiar with these prices, and how they are today. The other thing you should see relative to inflation is how dividends have grown steadily. And even if you look at the dip where it says entire drop due to financial sector, it very quickly recovered from that. And the chart at every stage was very well ahead of the consumer price index, that CPI line at the lower. You'll see that dividends, and you'll see that in a couple of other slides as well. I'm going to turn over now to Stefan So, who's going to deal with investing in REITs, which is a part of the portfolio we've been introducing selectively recently. And then to wrap up the presentation, I want to thank everybody very much for their time. It's been an honor to have you with us. As I said, we've got people who joined us from around the world. We're happy to have you all. And we wish you a good rest of the week. And we all pray for peace in Ukraine. May a miracle happen. May Putin be struck with some common sense and a heart that works, and peace reign in Europe, which is so badly needed. and all the destruction that has taken place and will certainly continue to take place if there isn't some miraculous intervention. We pray for those poor people. And with that, I hand over to Stefan, who will deal with his piece. Thank you, Stefan.
Thank you. And as Selwyn covered in terms of some of the factors that we're seeing, whether it's inflation or higher interest rates and so forth, what we've discussed internally here at RVW is how to really review and position some of the portfolios going forward. And as, again, Selwyn mentioned, we've been selectively introducing real estate and really looking at the private real estate space to see how we could navigate through these turbulent times. And so when we're talking about real estate, we're keeping also still our core investment philosophy in mind, which is one, diversification by sectors. So when we're looking at real estate, one area we've been reviewing quite heavily is industrials. So with industrials, meaning it could be warehouses or distribution centers, and these are being rented up by companies like an Amazon. And then from there, we have also, of course, residential, whether you're looking at single family or multifamily space. And then there's whole other areas of the real estate sector. That includes office, hospitality, retail, self-storage, and data centers. And in aggregate, all these components become core pieces that make up a good private real estate investment allocation. And from there, what we're looking at is for clients that are looking at it from a taxable account. Again, one of the ways we're adding value from an RVW side is for clients that have perhaps high tax rates, how to really minimize the tax implications and provide the best after-tax returns. A lot of these private real estate investments have good after-tax returns, given that on a technical level, a lot of the distributions, for example, become return of capital. That's really taking advantage of the tax code. And what that means is at the end of the day, the distributions are really being tax deferred. And then from there, looking at some of the areas like e-commerce, as we all know, it's been growing steadily for quite some time now. But one of the statistics that we saw was in one quarter back in 2015, the sales of the e-commerce was about $80 billion again in one quarter. And that's grown all the way to $200 billion plus in one quarter recently. So that really tells us that if you're looking at really the distribution centers and warehouses, that's one area to be in if you're looking for stable income and also some growth. And another fact that we really thought was interesting was if you're looking at companies like an Amazon and you're looking at their operating expenses, that number happens to be about 4% of the rental expenses as a part of an entire operating budget. Now, if we really take that to 5%, it's really not a big deal for companies like an Amazon, but it's really a 25% rental increase from our perspective. So when we're evaluating figures like this, those are important to make sure that if we continue to be in the real estate area, how do we continue to get strong rental income? And it's discussing about strong rental income for the past several decades, especially in the private real estate investment space, the income have been very steady. It's been ranging anywhere from on the low end on any given year around 2% all the way to 8% plus in terms of distributions. So we expect this to continue because the rental income and in terms of the asset classes that we invest in within real estate will remain steady. And as Selwyn mentioned, inflation is something that's on the top of all of our minds. And all data points to the fact that with real estate, it's also a good inflation hedge. And so that's where real estate will be a good, important component for those who are in need of income and so forth. And the other factor is rising interest rates. And actually, in looking at some of the data and what we've seen over the past several decades, is we've had a rising rate period back in 2016 to 2018. And so while the rates were rising, the real estate continued to perform in a very strong fashion. And so we've seen multiple periods where even though with rising interest rates, that could be potential headwinds for real estate, we've seen strong performance with real estate that. So again, as Selwyn mentioned, we've been selectively introducing real estate for some of our clients, but for those who are seeking more stable income or perhaps looking for a little bit less volatility within the portfolio, this could be an interesting solution to work through all those different factors. So please let one of us know. And in closing, our portfolios are extremely resilient. It really relies on Nobel Prize winning strategies. And again, given the way our, for example, exchange traded funds are rules based, which it really means it's a Darwinian type of model. The weak companies are getting replaced, whereas the stronger companies come in. A real live example of that is dividend paying companies. If certain companies are stopping to pay dividends, then it will automatically get kicked out. And a company that's continuing to pay dividends will either stay in or get added. So that really comes back to the idea of a Darwinian model. And on top of that, another important part is that it's extremely tax efficient. So normally, if you were to hold, again, on an example basis, Apple, you sell Apple in your taxable account and buy Microsoft, generally that would be a taxable event. Within the context of an exchange traded fund, that is because it's a stock for stock exchange. It's very similar to those who are real estate investors, a 1031 exchange. And so in those cases, it's generally not a taxable event. And so that's why we generally, again, employ exchange traded funds to access great companies. And again, portfolios we have designed have taken into account of uncertain times like the one we're facing now. And our core investment philosophy still remains the same. One, the diversification in number of companies, sectors, style of investments, and by geography. And two, tilting towards factors or attributes in the world of investments that are likely to outperform over time. And as a result, one of our most important role is to provide a steady hand on the wheel while continuing to build resilient portfolios. And so we'll continue to do that on behalf of all of our clients. Thank you, everyone, for joining us, and we look forward to our next webinar or hopefully in-person event soon. Thank you and have a great day.